Hey there, hello and welcome to a special segment called as MC Pro Select Stock of the Day. I'm your host, Nikki Michandani, and in this segment, we bring to you fundamentally strong investment stock ideas. Today's stock of the day is Central Depository Services Ltd, that is CDSL. Let's get to know more about the company, which stands as the sole listed depository in the market, a position that reflects its pivotal role in the financial sector. In the geopolitical industry, the CDSL operates alongside its counterpart, NSDL. CDSL plays a crucial role in modernizing and digitalizing the security market by facilitating the secure holding and seamless transaction of securities in electronic format through demat accounts. Now, why does MC Pro really like about the company? A couple of reasons out there. Let's address first one for you, which is low risk proxy for capital market growth. Now, the company stands as a low-risk proxy for capital market growth, representing a key beneficiary of thriving market and secondary markets. This particular sector essentially holds solid entry barriers which have been fortified the position of incumbents like CDSL and NSDL put together. As the financial markets continue to penetrate deeper into the economy, these established players are poised to reap substantial benefits. In a remarkable achievement, CDSL recently crossed a significant milestone, surpassing 9 crore active demat accounts in July. Furthermore, CDSL's market share in cumulative active demat account has exhibited impressive growth, surging from 40% in 2014 to a commanding 73% in FY 2023, which is diversified revenue profile of the company. It derives revenue from three primary resources, essentially annual issuer charges, transaction charges, and third, IPO and corporate action charges. Amongst these, annual issuer charges, which represent fixed fee charged by corporates, constitute the largest components of the company's revenue. The charges remain relatively stable and are not directly tied to capital market activity. In the first quarter of FY24, CDSL generated a significant 36% of its overall revenue from the annual issuer charges. On the other hand, transaction charges are contingent on trading volumes in the secondary market, while IPO and corporate action charges are market linked and depend on number of demat and investor accounts. With the thriving capital markets, especially in the primary sector, FY24 is expected to witness substantial growth in transaction and IPO and corporate action charges. Now, let's also understand yet another factor which is working in the favor of the company, which is new business lines that can drive future revenue growth of the company. CDSL has strategically deployed its capital into various business ventures. One notable entity, perhaps, is CDSL Ventures, a wholly owned subsidiary of CDSL, which specializes in providing KYC services for capital market intermediaries. Additionally, CDSL has ventured into the domains of insurance repository, enabling the secure holding of insurance policy in electronic form, and commodity repository, which facilitates the electronic storage of warehouse receipts. Although at present the subsidiaries may not be significant revenue contributors, they hold the potential to evolve into substantial revenue generators in the future. Let's talk about the financials, which seem to be solid, and outlook, which seems to be promising. CDSL is set to benefit from a surge in IPO and increased retail trading, poised for healthy revenue growth. In FY24, amidst the thriving capital markets with fixed employee and software costs, the company enjoys operating leverage, resulting into higher EBITDA margins. Additionally, the company's minimal capital expenditure requirements facilitate strong free cash flow generation and maintain a solid return on equity profile for the company. Valuation, let's talk about that. Currently, the company is trading at 34 times its expected earning for FY25. The valuation can be justified by several factors. A, it holds a prominent position in the sector with secular growth trends and due to absence of suitable and comparable listed peers with that like NSDL, whose proposed IPO has been put on hold, it commands a premium valuation with that. While the stock may appear to be expensive just on the surface, there is potential for upside in the market price driven by solid earning growth. Notably, the new business venture offers significant scalability to company's business model, which is not fully reflected in the current valuation of the company. This suggests that there might be further room for the stock to appreciate in the future. Well, with this, it's a wrap. Thank you so much for tuning in.